All right, folks, welcome back. This is the daily log entry for February 22nd, 2021. Okay, we're looking at the euro dollar. This is our 5-minute chart. Okay, so this is the 5-minute chart. And this high, I don't have more of the data showing over here, but you can obviously find this in your chart on TradingView. This is a 15-minute breaker. I'm using the last up close candle here on the 5-minute chart prior to the decline. During the London Open kill zone, we had a run below an initial low that was formed in the form of relative equal lows. Sell side liquidity pulling below that, and market drove down deeply into that right there. If you recall what I outlined over the weekend, I mentioned that we would still be looking for lower prices on dollar index, and that would translate into higher prices for euro dollar and pound dollar. Well, we set up a really nice raid on liquidity. This is engineering liquidity. Now, for your notes, you want to try to have a section in your study journal for liquidity. Okay, let that be a topic. By putting your daily log entry notes and annotations in, you're collecting information and insight that's being logged under your respective month. Like, for instance, most of you that just joined, you're logging all your insights and commentary on your charts in your month one content. So in your month one section of your study journal, this idea of engineering liquidity should be placed there, and it's got a specific example being shown here. But apart from that, in your study journal, there should be a area in it where you can just annotate bullet point ideas as it relates to liquidity. If we're looking for lower prices in the dollar index and higher prices in euro and cable, if we see relative equal lows forming in London, this is generally like a bait and slam. Okay, it's like having them put this here and laying the cheese right here for them to say, okay, well, this is support now. Retail sees this running up. They're going to feel real confident chasing that, buying it. And where they're going to put their stop loss? Right below there. So when there's a long lethargic price run after seeing a short-term high, always anticipate some kind of a short-term low forming in the London session like this. But the condition must be bullish underlyingly for the euro and bearish for dollar index. And if we see this double bottom type formation in London with the premise in mind that dollar should be going lower, foreign currency should be going higher, this is almost like a guarantee that they're setting you up, or retail traders up, for this initial run and then drop down. Now, don't take my word for it. You want to go back and look at your historical data and study that. Now, I know you probably won't be able to go back as far as you might want to go with a 5-minute chart on certain platforms. I know some brokers don't have a lot of data that go back that far with a 5-minute chart, but do the best you can. And going forward, you know that this is a signature that's classically associated with London Open kill zone. But again, don't look for double bottoms to be taken out if it's bearish and then see this. Okay, what we're saying is euro was most likely bullish. Okay, because of my stance on dollar, everything would be reversed in euro and in cable, and like Aussie dollar and New Zealand dollar and vice versa. Everything should be moving symmetrically. That means weaker dollar, higher foreign currency prices. If we see that underlying narrative at work, which is any decline down in a bullish currency, it's just going down to take out sell stops and then pair that up with their smart money long accumulation. So the selling that would be engineered down here, this provides a great deal of liquidity for when the market drives down and into a 60-minute bullish order block. It's accomplishing two things. It's purging the liquidity here, So those sellers that were already long, they get knocked out. It trades down to a bullish order block, then rallies up, and then we go right back to this reference point here. It's the lowest down closing price, extend it through, and there's your rejection block. So what you're seeing here is that little light bulb is there just to remind me to talk about the pattern. If you look at this swing low here, right at the order block, so you have a higher low and a higher low, and the low in the middle, there's your swing point. So if you take your fib and you extend it from that low up to the high here, you'll see that this is an optimal trade entry, which is also overlapping with a rejection block within the context of a underlyingly bullish pair with weakness in dollar in the kill zone. So it's occurring inside the kill zone, optimal trade entry, rejection block in the narrative. Initial target would be here, which would be buy side liquidity above here. And this level here, if you go back further on your chart, you'll see that's an old high back here somewhere. So it runs to that liquidity, comes back down in, and there's a buy side imbalance, sell side inefficiency, and an institutional order flow entry drill here, but it's between the kill zone, so I'm just adding it just a marker for you to have for your notes. And then we have the market trading into optimal trade entry here. So it's low, high, long, drawn out until it gets into New York. Then we get this initial run here and drops down one more time. This is why you don't want to trail your stop loss aggressively, and you will learn a specific approach to managing your stop loss. It's based on what you think the market's going to do, what target you think it's going to run to, and then you move it based on a percentage basis. And I'm not going to say anything more. Please don't email me, but it is taught in later lessons. Now, I want to take you back to the discussion I have been slowly working into our teachings and lectures, is the utilization of the London close kill zone. The London close kill zone can be used to get in sync with the higher time frame price move. So you can see we had pretty much a New York setup that was consolidation, and then it only really moved until London close. Low, high, optimal trade entry, breaker. So we have optimal trade entry with a bullish breaker, and then we have relative equal highs. So you know what's above that, buy side liquidity. So how far can it go above that? Well, it's essentially 21.55. So if we go 10 pips above that, it's 21.65, and it just about does that. Okay, so it's running in sync with the higher time frame. The setup forms in London close with the patterns you've already been introduced already with: relative equal highs, optimal trade entries, breakers, and the underlying context is bullish euro, bearish dollar. All right, so we're looking at the British pound versus US dollar. This is our 5-minute chart. All right, so here is a buy side liquidity pool, short-term high there, drops down, and this is essentially the same thing, just done across a longer period of time. So what am I saying? What I mentioned on the euro dollar, how it was creating a low, starts to move up a little bit. Now this one, it was just not willing to go up much from there. Then it dove deeply below that 140 big figure. 140 big figure, we've already worked that level, and I showed how it can do when it's moving in the direction of the underlying institutional order flow, which it is not doing here. Remember, British pound, we've been calling this higher. We've been not interested at all selling short this currency and just staying out of its way and just studying how it's been going higher and how it presents these opportunities to be long. Well, this drop down works below the 140 big figure. Does it work 20, 30, 40 pips? No. It goes against the underlying narrative. It's bullish. So what is it doing? It'll go down 10 pips, almost got 20 pips below the big figure. You see that? That's why I have the 90 level and the 80 there, just to show you in relationship to how much it went down. So it just fell short of reaching the 80 level. Now your brokerage firm, if you have a live account, you might want to look at these lows in here because it may have went a little bit lower on your platform than TradingView's Forex.com's data feed is showing. And study these lows across the other brokerage firms that TradingView offers, like Saxo and FXCM and the like. But same thing, engineering liquidity. So sell-side liquidity is taken here. It sweeps also the liquidity below the 140 big figure, and it goes just about 20 pips, not quite 20. Runs into the London Open kill zone, rallies, comes back down into an order block. Now, if you don't understand that this pair was predominantly bullish, and you have been just casually introduced to the idea of coming back up into this imbalance here, so the sell side imbalance, buy side inefficiency, when it comes back up to this point here, even though it completely rebalances that, about 98% of it, does that mean it's a short to take out these lows? No, because we've already done the work of clearing a big figure. We went essentially 20 pips below the big figure. We're in the heart of London, and when it rallies back up to rebalance here, we want to see it come back down to a discount. While it's a premium from here to here and then rallies back up, this is a premium. And if it was bearish, this would be an ideal area to sell short. But have we been bearish on British pound? No. We've been getting out of its way because it's a freight train, just doesn't want to go down. So in respect to what it has done here, we go back to the previous low, which would be here. So we have low to high, then it drops down below 50% of that, which is now a discount. What discount PD array would we look to couple with that discount relative to its dealing range, low to high? The last down close candle, which is your bullish order block. Sending out in time, optimal trade entry, order block after sweeping 140 big figure. Rallies. Everyone else is going to look at this and say, this is an optimal trade entry, it's a sell, and it rebalanced all this here, so therefore it has to be a sell. And if they sold here and it started going down, they felt really good, I'm sure, for a few moments. Then reality kicks in and it runs, clears the initial buy side liquidity here, consolidates. What's it waiting for? It's waiting for New York Open. There's an institutional order flow entry drill in here with this small little fair value gap. I just didn't add the fair value gap annotation because the real interesting point is that low, it trades just to it and a little bit through it. There, that's your entry point. It's also occurring in London Open. So you could be a buyer there. Your stop would have to be below this swing low and let it go. It needs to at least go above here before you'd ever consider moving your stop. Taking partials fulfills that desire to move the stop. You don't need to move the stop. Pay yourself along the way, and you'll realize how easy it is to keep the stop at the initial position until you learn all the techniques about managing your stop loss. I teach it late in the mentorship because it's meant to keep you from wanting to trade with live funds. So it's designed that way for a reason. It's not dangling a carrot like, haha, you can't have it. It's not appropriate for you to know it now because you need to learn all these signatures that reoccur in price action. So we have New York Open, and the market trades down into the fair value gap here. Not here, we're not interested there. It does it here and here. If you look at the range between the low to high, we're at a discount and a fair value gap and the New York Open kill zone, and liquidity that has yet to be taken. Has it traded to it here? No, it hasn't gone up that far yet. So it's pulling back into a retracement, and British pound, we've been calling it higher, so we get this displacement here. And then it retraces back down, small little fair value gap with a bullish order block, optimal trade entry, but between New York Open and London close. So while this is the better entry, this is the one that's going to stand out to you. Can you use this as an entry? Yes, because you're confident, you know that you're trading in sync with institutional order flow. The bullish underlying premise in this pair, it's just like this here. You know, if this would have been between the kill zones between London Open and New York, that would be a way for me to add something if I was taking a trade in this pair. Even though it's not in the actual kill zones, you're going to learn, because some of you in the first month are just terribly concerned about this kill zone doesn't line up with what you showed on the YouTube channel, and it doesn't match the one you taught in your free tutorials, and it doesn't do this, and it doesn't right. I'm teaching you time and price theory. And I mentioned also a week ago or so, try not to get so caught up in these respective times. because they're going to change as you go further into the mentorship. And you're going to learn that with the economic calendar, certain days of the week, weekly range profiles, all those things are going to affect these kill zones. But for now, just trust me, folks. Okay, I'm taking you somewhere. It's not important for you to know exactly where we're going 5 stops ahead from now. Okay, just be content with what I'm showing you now. Okay, because it builds on your understanding. If I give you everything about kill zones, it's just going to create a myriad of different questions that you're never going to feel satisfied in. So working with this, it's still creating important lows. Okay, and we didn't quite get to the high, almost got there, but nonetheless, this here is a level that if you go out to your weekly chart, it's your bearish order block. So if you look at the setup here between the kill zones, London and New York, optimal trade entry, fair value gap, bullish order block, then it rallies again, trades back down into mitigation, which is the last up close candle prior to this decline. This low did not take out that low, so it's not a breaker, it's a mitigation block. Extending out in time. Look how the bodies respect that. Yes, we have a little bit of wicks in here, or tails, and then it rallies up and reaches into the 140.80 level. And there's a little bit of a fair value gap and small imbalance there. I would suggest that if we take out this area here, I don't think it would be a rundown for liquidity. I think it would be more impactful for short-term change in direction. And I'm not trying to call the top in British pound, but you know that Powell's speaking this week, and that might be a concern if we trade back down here. Okay, and it might upset the near-term bullishness for British pound. We have relative equal highs in here, so that doesn't look like a top to me. And I know we're looking at a 5-minute chart, but nonetheless, it would need to come back below here on a closing basis for me to, at least for this week, put the bullishness on the back burner. And I think that's going to be it for tonight. Some of the topics I'm going to talk about this week, I don't know where I'm going to place them, but I'm going to talk a little bit about TGIF setups, and I'm going to talk a little bit about the higher time frame setup that helps you stay on course with these types of setups here. So it helps build a little bit more understanding about what it is that you're looking for, because I've been teaching you to look at the times of the day and how these intraday turning points occur very, very routinely at specific times of the day. And if you understand the logic of why the market should be reaching for something higher or lower in price on a higher time frame level, it really makes it not perfect and easy, but it makes it far easier than if you were to just use some kind of a moving average. And how do you know which moving average to follow? And how do you know which support and resistance level to follow? So I'm teaching you focusing predominantly on time. Notice that this entire first month for the first group that just came in, and for those that are going through the mentorship all over again, trying to go through it the proper way, the main focus has been for the first month is focusing on the time element. Time. Because if you don't have that part right, everything else is going to be wrong. You're seeing there's certain little patterns here that are occurring between the kill zones. It doesn't mean these kill zones are not accurate. It doesn't mean that the system's messed up. It does not mean that IPTA is failing. And I'll close this video with a little remark here, because some of the folks that have just started, and a couple people in later months, and I had one charter member from, I think, 2018 group, send me email with concerns about the global economic collapse and the dollar collapse, and is this going to cause, with me teaching so many new people and everybody else copying it, and they're trying to revamp it, and is that going to affect the algorithm? The algorithm doesn't know your trade is even in the marketplace. Okay, it doesn't know your orders. It just knows patterns that it follows and macros, and it's basically how I teach you to look at price. That's the first building blocks to how the algorithm is designed. It doesn't need to know how many people have a sell stop below that. And it doesn't need to know how many people have a buy stop above that. It just knows it does. That's the logic that you're being told in all these books. So it turns all those things against the bulk of traders. It's also along the lines that all of this here is not driven up by buyers. Okay, the British pound didn't go up from here to here because of buying pressure. That doesn't cause that to go up. And you see a lot of people that are trying to reteach my stuff in ignorance. They will say, yeah, they bought here, smart money bought it here and drove price up. That's not what happens. Okay, that's not what happens, and that is not what the algorithm does, because that supposes that buying and selling pressure has an effect on price, and it doesn't. It does not. If you consider what the algorithm is actually doing, and this is why it's not going to fail. When I say it's not going to fail, I'm not saying that certain currencies might not fall out of favor or liquidity. And they mean like for instance, Deutschmark. When I was a commodity trader back in the 90s, I used to trade the D-Mark. Well, we don't trade D-Mark anymore. Much like a commodity, pork bellies. I used to trade pork bellies, and they don't trade at all anymore either. They just don't exist. Now, if you look at how I'm teaching you price, you're concerned for whether the dollar collapses or it doesn't collapse in our lifetime. It's really of no concern to you, or it shouldn't be, because there's always going to be a market. And because of that, these same principles will exist in other markets. I've said this before, and I've said it so many times in the past, and there's a lot of you that are brand new and you're just nervous, and I understand the concern because it feels too good to be true, and it just so happens that now you're getting involved, and watch what happens. I'm going to start learning how to do this and then they're going to start letting it work, and then I'm going to be left outside in the cold. I know what you're feeling, but these are the same questions that people were asking back on 2010 when I was on Baby Pips, and I used to laugh and say all the time, there's no reason for that, because if there was any concern, I would have never taught this. I would have done something else. I would have watered it down and said, okay, let's look at this and let's look at that. I'm teaching you how it prints and books price, because this is how market making has always been done. You just have never been taught because nobody knows it. No one's wrote books about this stuff. No one's made courses about it until I started releasing ideas around in 1996. Okay? So if we know that the market is bullish and it goes from here to here, is it buying and selling pressure that leads from here to here? No, it's not. Because you only need one trade to print in the market. Does it matter if it's $1,000 worth of this currency or if it's $2 billion? No, it does not matter what it is. Whatever that block of the currency is that prints and makes a transaction, that's where the market's going to trade to. Now, the algorithm will offer that price. This is what you don't realize. The algorithm is offering the price higher, higher, higher. There may be tons of sellers in here, tons of them, and they would be coming here selling with the idea that they think it's going to go down because it went to this level here before. So therefore, if it goes back up to that level again, they think it's going to go lower. Now, I'm not saying that's right or wrong. I'm just saying think about it like that for a moment, just so you can understand what I'm saying. The market algorithm, and it's not just limited to currencies, okay, because they're all slowly but surely moving into this AI format. It will offer price higher. Okay, it'll go 140.27. Whether there's a trade interest at that price or not, it'll offer 140.28 and then offer 140.29. And then sometimes, as you'll learn as a charter member later in this year, the market will do this gapping up where it'll jump over certain prices. And that's what you get in here, where you get these big candles. That's the nature of a fair value gap, because it will jump up. Now, the folks that are trying to rip me off and claim that they have the sauce because they've seen some things I teach, they will say, yeah, the buyers in here, okay, there's too much buying in here, so then now you got to come back down and fill in that inefficiency. No, when I say it's a buy side imbalance, sell side inefficiency, the algorithm has offered too much of an advanced delivery for buy side. In other words, it moved too far above a particular range in price without spending enough time in there to offer sellers the opportunity to sell at price range. So the algorithm is predominantly trying to reprice to an underlying price level. It starts here, then a higher time frame level here, and it creates near-term pools of liquidity. When it drops down in here, it knows that there's going to be buy-side liquidity pulling above here. Buyers are going to want to be buying above that because they're selling short here. They're always going to be traders chasing the marketplace. But when the market goes down, it's not because it's ran out of buyers. It's not because it's more sellers. It's because the algorithm is pricing it that way. And the trader, unless you trade all the time with a limit order, you're going to get whatever the price is given to you at the market. And guess what? If you do a limit order, it's still a market order within a price range. So it's still always going to be a market order. When you trade with a stop, that stop gets triggered by price, and then it becomes a market order. The limit orders limit what you're willing to pay in price. A stop is get me out right now. At the earliest convenient price that is made available to me, I want out just like that. A limit order is just the same as that, but it puts it in a defined range where it says, okay, I want to buy, like for instance, say we want to be buyers at 140.30 and it drops down below 140.30. Okay, the next price that prints, it might be 140.29. You see it on your screen, but then it fills you at 140.30. You didn't get that good 1 pip slippage. Well, that's because the broker is not going to let you have that. But you have limited what you're willing to pay. Like you're not going to pay 140.32. That limit won't fill. So it's going to allow you to get a specific price range or better. Okay, so back to the buying and selling pressure idea. The algorithm, when it declines, it's dropping down to this price point here. Now, if you just take a couple moments to just think about what I've been teaching you just for the first month. If 90% of people lose, and these markets are rigged, like I'm saying they are, how can it be defended when you make a case that the markets are not manipulated or controlled to the degree that I say they are? And if that's the case, then why is it that all of this selling pressure stops right where I teach you where it should stop? Why don't it go beyond it? Why isn't there a lot more chaos in price? Well, just the first month I've shown you there's some things in here that you've never been seeing in your studies before. No other teacher's been talking about them unless they spend time with me. But the point is, you are seeing things that teach you that there are things in play and keeping these markets in control. So when it goes up, when this run from here to here happens, is it just randomly going from here to here? No. It's going from here because there's an inefficiency it's worked off of and a time element. Price runs. What's it running for? The buy stops resting right above this high. It goes there and starts to drop back down. Why is it doing that? It's picking up more orders here. Why does it want to come back to this area here? Because it left a small little imbalance and it spent too much time here before this displacement occurs. Then it drops back down, and this is signaling to smart money traders, those individuals that understand what the algorithm is doing. what you're saying, if you're arguing from the stance of a retail trader that doesn't believe what I'm saying, is that the market is just randomly staying here inside this little fair value gap and then going higher because everybody that usually loses 90% of the time was lucky here to buy, and then all the buying pressure took it back up above this high and above this high, and then it retraces a small little bit and goes right into a mitigation block. Now, one could argue and say, well, this is classic support and resistance. I'll give you that one for this one, but I'm teaching you it's mitigation. There's going to be some overlap, and you'll see the way I teach you the idea of institutional order flow and where trades should form. You'll unlock retail support and resistance theory the way the books try to give you the impression it's so easy to just do it this way. And then when you try to trade it with live funds, you always get the support and resistance levels wrong, just like diagonal support and resistance trend lines. There's always different ways to draw it. The problem is which one's the right one. And that's why I have no faith in them. They're too subjective. What I'm teaching you is not subjective. It's very specific. And when the price is dropping down like this, notice that it's doing it tightly, not real quick like this. See that? This is going somewhere quickly because it needs to get the liquidity, and it's going to excite retail traders. That's the design behind it. Whereas over here, they just want to keep it real quiet. Then it offers the price right back down into here. Look at the bodies respecting that. Body to body. Then it rallies back up. Runs into your higher time frame PD array. This is not buying pressure. Again, it's the algorithm starting at around 140, 47-ish or so. Then it starts offering the price higher. It does not matter. It does not matter how many people come in and selling short. It's not going to make a difference. The price is going to keep going up. You ever been into a position where you sold short and you're like, okay, well, this is really the better price I would have rather have sold short. So let me sell another piece here because I just think I'm right. And then it goes up higher. And I'm going to sell more because you're angry and you're revenge trading and you take your stop loss off. And then you get this type of move against you and you're just completely blown out and you got a 20% loss in your account. You ever done anything like that? I'm raising my hand. I've done that stuff in the 90s. I did that. Why didn't your selling pressure have any effect? You think you're the only one that was trying to sell short? This is why it's hard for people to come under my wing if they've spent a lot of time in retail. It doesn't make sense. It's easy for them to say this is nonsense because it's uncomfortable. But when you take a step back and really study it, it's the repricing higher that continuously happens, and it does not matter that there's buying and selling going on at all, because this game is not for you. Now, let's strip it away for a moment. No buying and selling pressure. It's completely controlled. Look at it from that perspective. Now listen to this and you'll see how it just makes perfect sense. But if you don't go into it with this mindset, and nobody does, which is why it's hidden from you. No one goes in with this perspective until they spend time with me. This market's bullish. You've known this ahead of time. You know that in London, it creates the low of the day. If it's bullish, Monday, Tuesday, and Wednesday, you have a high probability that it's going to create the low of the day in London. Isn't this the London kill zone? I mean, I didn't just make this up for this example. I mean, you know that. Big figure sweeps below that, just about 20 pips, but it takes it and then it accumulates underneath that big figure. Then price rallies. If this is going down for smart money interbank traders, people you're not meeting, I'm not talking about Citi, I'm not talking about Goldman Sachs, I'm not talking about Saxo traders, I'm not talking about any of those people. These are people you don't know, and they make no names for themselves. They don't draw any attention to themselves. They are trading for the bank. What bank? The central banks. It's their commodity. They're in control of all this stuff. That's how bad this stuff is, folks. Okay, it's rigged. As much as you can have rigged anything, it's rigged. So if this is designed for them only to buy, their idea of getting out is already up here and here. So what they're going to wait around for is what I'm teaching you. when they bought down here, price is going up. It doesn't matter how many people are selling short. It doesn't matter if Goldman Sachs is selling short. It doesn't matter if, everybody is watching certain articles come across the news wires about British pound, Brexit this, Brexit that. Boris Johnson has a cold. He's changed his brand of underwear. Whatever it is that you think or have faith in that causes some fluctuations in the price action, it's irrelevant, because this is doing one thing. It's marching to this liquidity here. And it does not matter what trend lines you have. It doesn't matter what harmonic pattern you have. It doesn't matter what wave Elliott found this morning to ride on. It doesn't make a difference. None of that stuff has any impact on what price is doing. It's marching up, and then it gets right to a New York kill zone, and it pulls back and allows them to do what? On board. Pick up orders, pick up orders, pick up orders, rally displacement. So if they missed any of this in here, this is their key. Okay, we got to wait for a retracement. Pull back. Where's it going to pull back to? This random down close candle right here with a gap. That's just completely retail, isn't it? That's exactly what I teach you. So they wait for this. They buy it in here. They buy it in here. And they wait. They don't go in and say, I'm going to keep buying more and drive price up. That's not what happens. They buy and wait because they know the algorithm is going to work within this time element here. So the market trades higher. When it goes above here, these interbank traders offset their longs from here and here and here with this liquidity. Not all of it, but a certain amount of it. And that's what you're seeing here. Now, by them offloading it here, does that mean them selling it drives it down? No, that's not what's occurring there either. It's just allowing them the opportunity to see how it drives up aggressively. That one candle, it pushes really hard above that, right in there. What is that doing? That's causing traders to do what? Chase it. So now they're buying it right here at the high of the candle. They don't have this level here. That's what I teach. They're thinking, okay, it's going up now. Retail wants to buy it. Then there's a retracement in here, and it slowly drips down and down and down, and they get squeezed out of it. So when they get out of that trade and they bought it up here, what is that doing? That's providing more liquidity in the marketplace for selling. So why would that be useful? Smart money would accumulate at that mitigation block right there to the pools of liquidity that's being formed with this retracement by the algorithm, not a lack of buying, not an increase of selling. It's just repricing and manipulating the perception of traders. And then when it trades to this level here, traders know that there will be an influx of sell side liquidity because they're selling out of this position that's being pulled against them, because retail wants it to go immediately. You know what it's like when you traded before you should have. You put a trade on with a live account and you thought it should run away immediately. And when it didn't, you tend to freak out, and you might have a stop loss. Maybe you do or don't. But if you did, you're moving it away because you don't want to get stopped out. And then when you do that, then it's like, oh, I can't handle this pressure. And you just get out. You just close the trade. Well, that's what's going on right in here. That's what's occurring. So if you've bought up here as a retail chasing trader and it retraces down here to get out of that long, what are you doing? Selling. And that influx of sell side liquidity marches to the beat of this mitigation block, and then you see this. It starts to reprice higher, and then retail looks at this high here, it trades through it. What do they want to do? Watch a little bit more. Yeah, it's going up. Let me go back in and buy it again. And then it goes here, and then it'll probably retrace and go into this range again. The algorithm is pricing higher and lower continuously. And it's moving from one period of time to another period of time to another period of time, under the premise of an underlying narrative that this pair is bullish because the dollar is weaker. And it's going to a pool of liquidity, either external or internal range. That's all it's doing, folks. It is not buyers pushing price up or sellers pushing price down. The price is being offered whether you want to be a buyer or seller there or not. Now, back to that question I pose to you. If we are to believe that 90% of traders lose money when they trade with live funds, okay, that's a pretty significant number. If that's the case, then how does the logic of buying and selling pressure line up with such a underlying failure rate that's available in trading? If 90% of people lose money, okay, and everything that you are learning in books, and it's buying and selling pressure, it's supply and demand, if those things are true, then why is it that there's a 90% fatality rate in the trading industry? Because it's a net sum zero game. See, they tell you that because on every side of every trade, there is a loser. So yes, there is a 90% likelihood of you losing money. But if we go back to the reality of everything, it's a net sum zero game. There's always a winner, there's always a loser. So if there's a 90% loser crowd and it's a net sum zero game, that means for those 90% of losers, you already know I'm going with this, that means there's 90% winners. What? Yeah. That's the default nature of this business. The smart money is 90% right. And the losing crowd that doesn't want to listen to what they call as conspiracy, or the markets aren't rigged, can't be. The market's too big to be rigged. What you're saying is that central banks are leaving it up to chance and the buying and selling collectively of the little guys, because there's a lot more little guys than there are bankers. And that's why I made fun, and not to be mean, but I literally made fun of the people that said, yeah, we're going to cripple the big guys and buy up GameStop stock. And all they did was gave you a pump and dump. And they all bought that hook, line, and sinker. The markets are not going to stop working like this, folks. This is such a perfect game. It's a perfect game because there's a sucker born every day. Every single day. I told you all this. I told you that stock was going to crash. I told you that it wasn't going to do it. And it did. It crashed. And people lost. Now there's court cases and all this other stuff, and none of it's going to bring to light what I've been teaching you. All that was a pump and dump. They knew what these people were doing in those chat rooms, and they knew there was a large buying interest. So what did they do? The market makers at that stock just started offering premium pricing. Let's see if there's any takers. And there was. Well, as long as there was, they keep pricing it higher. When it gets a certain price, they're going to sell their stock. And then we're back down below $50 a share. But it was $400+ ICT. Yeah, it was. But notice the day that it was doing that, you weren't allowed to trade it. Seems rigged to me. But what do I know? I'm just some guy on the internet. So anyway, the point is this. Do not worry about what you're learning eventually stopping, because this has always been done the same way, where everything is artificially driven now from an algorithm. That means artificial intelligence is making price go up and down. Okay. The idea of pre-computer trading, in other words, before everything went to electronic trading, there were men that literally sat in rooms and worked together to make the fluctuations in price. They were the real market makers. That's how it operated. It's far more efficient to program these things and not have a disgruntled person, because these men are human. They could have had a bad day. They could have been sick. They could have misspoke. They could have done something that caused an issue or an error, and that would be less efficient of a way of making a market and pricing an asset. Because everything's electronic and things are becoming better You should not be fearing these things becoming widely known, okay? Because think about it. I've been talking about this stuff for 10 years. 10 years. Where's everybody's yacht? Now think about what I'm saying now. Where's all the Lamborghinis? Where's the yachts? Where's the mansions? Because there should be all kinds of people on Baby Pips showing those things. You see what works. You see it. But I was introducing these ideas on a basic level, and that is enough to make money. But why is it that Baby Pips doesn't have any millionaires over there? Because I told you all back then, in 2010, I could literally put this on the front page of USA Today, spell it out for you, and it still wouldn't get used because it takes discipline. It takes discipline. It takes planning. It takes rule-based theory. And all of that stuff is what you're learning here in mentorship. I'm forcing you into it. That's why these lessons come out at the delivery pace that it is. And it's also the reason why when people get leaked content, they're not making money. They're not doing it. They might get a hit once in a while, and you'll see them really post that stuff on their social media. Look at me, I'm killing ICT. Yeah. Show me the last 6 weeks. They won't do that because that will make them feel terrible about themselves, because those one-hit wonders that come along, that's just enough to keep them going, but it's not making them money because they're not doing it properly. So don't be fearful that I'm teaching this, because there's a great deal of you that are learning this that are going to quit. You're going to quit before you even get to month 2. I already know it. I'm not upset about it. It might be varying reasons why you're quitting, but it's normal. I always see it. Every time I bring a group in, somebody thinks to themselves, this is too much work, or this isn't what I thought it was. I thought this was signals, even though it wasn't offered to me. You see how much is involved here. And you also see that it takes a routine of doing this every single day and conditioning yourself and seeing it. And over a period of time, you start seeing something that you aren't really looking at right now. You see it where I'm pointing it out, but you don't see it when you're looking at the price charts because you want to trade live right now, because it isn't useful to you unless you're making money right now. I'm paying you $155. I better see some money. Okay. Quit. Because you are not in the right state of mind to learn. Period. All those people that watched, I still have the highest viewed threads on Baby Pips. Millions of views. Now, I took most of my content down because I launched it through YouTube. But everybody still sees it. It's up on my YouTube channel. Where are the millionaires? Where are the yachts? Where are the mansions? They can't follow the rules that you're learning here. Now, it's interesting. I have profitable students here. I didn't have any profitable students on Baby Pips. Why is that? Why is that? Why isn't that all those people watching those videos back then couldn't make money? Now, all of a sudden, I got people that want to start signal services now. You know, I'm not providing you signals, but they're ready because they know they're consistent. They're ready to start their own business. There's nothing wrong with that. I have no problem with that. I teach you how to do that in this mentorship and not be at odds with me. Because the people here have submitted to this process. They have gone through the mentorship not once, multiple times. They keep a journal and they write down their weak points, and they make sure they record, I'm unsure about this. I need to come back to this topic. Now, is that self-defeating when you say that? No. It's highlighting an area of opportunity for you to dig into it, research it more. And then when I go into new content each month with you, see if I'm talking about those things and how it builds on the idea that you have a lack of understanding in. That's how you progress through this mentorship. When you get your new month's content in month 2, do not think that you got to go through those real quick. those 8 lessons at the top, they're just foundational. I've already said this, and I want you to know that what I'm saying is actually going to happen. Every single month that you go forward in this mentorship, those 8 lessons, when I'm done this group, those 8 lessons from each month, they're going up on my YouTube channel for free. Why am I doing that? To prove to you that you didn't pay for just those lessons. They're just a language. That's what everybody's trying to sell right now. And the people that are buying the ripped off version of it right now hear me talking, and they're thinking, well, yeah, I'm not going to buy any more of that because I'll get that later on next year. But you are getting the real lessons, which is 2021's videos. And that's the ones I'm watching. That's the ones I'm putting specific watermarks in groups, because that content is what we're tracking. I don't care about every other video I've ever produced, because that's all been basic. It's been primer to this. It's all been viral advertising for me, and it worked beautifully. All these people that just came in, that was a result predominantly of what they saw shared. Now, if I did a poll, I guarantee you at least 70% of the people that just came in, they all have majority of the monthly lessons that will be given to you as you progress through the core content. The months that you're paying, those lessons at the top, those 8 lessons, they're foundational. You need to go through them properly in the order that they're given you. And you also have to go through what I'm teaching you here every day and every week with the midweek and weekend commentary. That's the mentorship. And me talking about it before it happens. Where is it going next? And what you should be focusing on. And now what should you pull out of that price action that was salient to your learning? That's mentorship. That's the reason why these people that sit around in these Telegram rooms and Discord channels and people that pretend to know how to do this stuff and create mentorships, but they're just repeating what I'm saying, that's why they aren't making money. And that's why they won't answer my challenge when I said, let's trade. Let's go out there and trade live. You can do this stuff. Let's do it. Let's show everybody what's going on. And none of them will do it. Not even for money, they won't do it. It's easy for them to sell what I've already said. What you're going to learn is in these lessons that I'm producing in 2021. This is the real mentorship. This is it. I waited till this year. There will absolutely be no more after this one. Will there be people selling these 2021 lessons? Sure, until I catch them. Sure. But we've been breaking the user groups down into smaller groups. And it doesn't take long to figure out who's doing it. But you won't be here to see it all if you're doing that kind of stuff. And you won't learn unless you submit to what it is I'm pushing you through. Those 8 lessons you get each month, you watch those. Try to do one of them a day and stay up to date with the daily log entries and then the midweek review and the weekend commentary. That's important because that's me talking about right now market conditions. That's me saying this is what's going to most likely draw to this area, and I don't like it if it does this. That's not plan A, that's not plan B. That's I'm telling you what I'd like to see happen, and if this does not occur and this very thing happens, I'm wrong, and there it is. Not plan A, plan B, and let me see which one I'm right about. That's not what we do here. I'm telling you what I want to see happen. I want to see specific things happen. And over time, you're going to learn that these things I'm looking for, there's logic behind them. I'm not making things up as I go along. I'm not ringing in something because it looks like it works in this chart today, so therefore we'll never talk about it again. No. Like, these things repeat over and over and over again. So if you think about what I just said, each month you have what was being given to you. If you were here in the 2016 era, there was daily live sessions. We don't do live sessions anymore because they would be abused. The live session recordings for each month that was given for the 2016 and then eventually 2017 charter members, those videos I get asked a lot about, should I look at those videos? And the answer is yes. But is it imperative that you look at them right now? No. The commentaries that you get underneath the 8 lessons, there are lessons tucked in those live sessions. I just did it a lot where I was just talking about certain things and I would drop little nuggets about what it is that's going on in the chart or what isn't going on in the chart at the time. And the folks that came in at the time and subscribed, they were wanting me to be calling trades out, doing trades in front of them live and watching it go, and then everybody giving each other a high five. And I didn't tell them they were going to see live session signals either, but they just didn't want to be around for that. And that's why you get people will say, oh yeah, he traded terribly. It was a failure. It was this, it was that. And these are the same people that try to make a mentorship with my stuff and say they help other people and they don't. And I threw him out because he was trying to sell my stuff. AG. So these ideas that you have that are concerning for you right now, don't let them bother you. If you're worrying about anything, that's going to be an impediment on your learning. It's going to be a barrier. Okay? I've already given you way more than you're supposed to. I've given you 3 times more than what you paid for. You were supposed to get 2 videos a week. You're getting a video every day except for Saturday. Real quick, a couple people are asking, like, where's the other video that should have happened? Because usually you get the daily log entry on Friday, and then on Sunday I did the midweek review. I'm sorry, the weekend edition review. I took the weekend off, and I did the commentary that I wanted to give and the daily log entry on Friday's video. Friday's video essentially is the daily log entry for Friday and the weekend commentary. I didn't do a video on Sunday because I needed to have time away from everybody and everything. So I grounded myself. I feel good today. Obviously, you can hear me. I'm going on and on and on. This is usually like an 8 to 10 minute video. But I'm addressing certain questions that I looked over the email inbox, and I was writing down a bullet point list of things I wanted to touch on this week. And one of the things that kept coming up was fearful of this stopping, and it isn't going to stop. And the idea of, because I mentioned about me putting up the 8 lessons on my YouTube channel. Some of you hear that, especially the new folks. You're like, what? Well, why should I pay? Well, here's what I want you to think about this. If you think that those 8 lessons that you got for the first month was all that you learned this month, then by all means, don't continue and wait for me next year to put each month's content up on those videos. And then there you go. But I will not be putting up these videos that you're doing with me right now. This one here, this is 2021 content. That is not going on my YouTube channel because this is where I'm going to release all this stuff. And I'm proving to you, I want you to understand that those 8 lessons have always been primer. And notice also that none of your lessons in each month have a watermark. Did you notice that? All these lessons have a watermark. They have your user group in them. So that way when someone puts a video out on Telegram, or they put their video out on Discord, or they share it on a mega file thing or something to that effect, or Google Drive, invariably it gets shared with me. And then I know where that leak is in that user group. So then I take that user group and I take it from 1,000 members down to 4 groups of 250. And then I wait for that new group. One of those groups of 250 will leak again. And then my attention goes to that 250. And then I'll break that 250 down into 5 groups of 50. You see where I'm going with this? That's how I'm catching people. That's how I threw a charter member from 2019 out last week. I didn't need anybody to turn him in. I seen that on a Telegram channel. So everything has been done in a way where it allowed me for free to advertise. I knew my content would be spread everywhere, and it was. Those 8 lessons are insignificant, even though they may feel like this is the greatest thing I've ever seen in my life. If you've never seen things like this in trading, I understand that, but it's infinitely better what you're about to learn. Those lessons are just foundation. The 2021 commentaries that you're getting and I'm doing right now, this is the real learning. This is the real mentorship. And I don't want you worrying about those things that you see each month. They're essential. They're absolutely essential. But they don't have a watermark because I wanted those lessons to spread because it's free advertising. It became viral. And everybody's laughing their rear ends off thinking they beat me. They didn't do anything except for work for me. And all of you that just came in, predominantly, most of you, already said you have mentorship videos. So why are you here paying? Think about it, because you know that wasn't it. That's just getting you thirsty. And now you're here and you see there's something different. Right. This is the real mentorship. And it's also, again, it's your choice. I'm not trying to twist your arm. I'm not trying to say, please stay here. I'm going to sugarcoat it and say, please, I'm going to give you the secrets over here. Don't quit and wait for YouTube. If that's how you're going to think about it, then please do it. I don't want anybody here to be unsatisfied, because you're going to get what you want if you stay here and put the time in. You will get it. But if you're just in here dabbling and you just really don't want to invest the full amount of money, if it isn't really ringing your bell for you, then you're probably the person that probably should just wait until next year. And then each month I'll put a group of those videos up, and the public's going to go crazy and they're going to think they won the lottery too. But they're going to realize also, wow, as good as that stuff is, there's something missing. Exactly me walking them through it, just like I'm doing with you right now. It's important. That part's important. I designed this very mentorship. I designed it this way way before I started putting the videos down. So you have a choice. You can do it the right way. And yes, it costs money, but you knew what it cost before you came in. Or you can do it lazily and be like everybody else in Telegram and Discord rooms, and they have no idea what they're doing. None. Do I feel sorry for them? No, I don't. Because the invitation was made available just like it was for you. But they want the cheap seats. They want the way of doing it where it doesn't really cost them any time or effort, or in this case, money. So each day you have an opportunity to gain more insight, more learning, but don't put your attention on the things that are the least of concern, like worrying about what order to go into, okay, on the content. It's given to you in the order they're supposed to be watched. Each new month content, the first video in the list of 8 at the top, you watch that one. And again, don't try to cram them all in the first day. Like, you're not retaining any of that. Many of you are watching it just to watch a magic trick be performed for you. That's not what it is. It's foundation. It's like learning a new language, and it's not easy. It's a lot of stuff. So when you go through the lessons, pace yourself. Some of you aren't going to be able to do this in 13 months, okay? You have to make the payments on time. That's part of the terms. But it may require you 16 months to complete it. And when you get to month 5, you'll see why. It's a lot. That month has a lot of lessons, way more than any other month. And it's going to intimidate you. And we get people quitting a lot when you get to month 5 because there's so much stuff. And it feels like it's filler. It's not. I talk about PD arrays and if the data ranges, and they're topics that I'm going to cover a lot. When we get into the spring months of this year, we're going to be talking about those a lot. They're useful, and what everybody thinks they do or don't do, they have no idea. They have no idea. So there's a lot of things ahead that are going to feel intimidating the first time I mention them. All you need to do is take notes and write down any questions that arise when I talk about it. Do not email me. Okay? I'm not trying to be the worst teacher in the world. Okay? I know it feels like I need to know this. You don't need to know it, because for me to answer it requires me to touch on other topics. Then it makes it perfectly clear to you what it is that you were missing. It's normal for you to be missing some logic in every one of these concepts. As the first time I introduce them, they're not complete the first time I talk about them, because it's a deep topic. They all work together, and they all work together with certain macros. The macro is like a little short order of processes that must be there, and you keep doing it over and over and over again in a certain way. That's what these markets do. It doesn't feel like it. It feels like it's chaos and random. It's not. Clearly it's not. But you have to trust me in where I'm taking you, because the folks that haven't gone through the mentorship like I'm teaching now, like for instance, I got 2017 and 2018 members, and they're emailing saying, man, you're spoiling the new group. Some of you don't think this is being spoiled. You're like, man, this isn't what I thought. But they all have been through it. They've gone through it. The first group, they went the hardest. Like they had the least. And it was like, I was really trying to weed out the people that I didn't want here. Like I was really trying to push them out the door. They see what you get now. It's like, man, I wish I would have waited this long to join, because now it's like, you're just laying it out there for them. I had to do all this stuff myself. Well, obviously they're being facetious, but the point is, you are getting the most hand holding that any group has ever had, and they're benefiting from it as well, because they're seeing what they should be doing in contrast to what they've been doing, and they're learning because of that. And it's, again, another benefit of, if you go through the content and you become a charter member and you're like, yeah, I watched every video. Okay, now go back through it. Do you need to watch every single video? Probably not. If you can, do it, because you're going to find that I've talked about something in that video that you did not hear the first time. You'll swear up and down that it's something been edited, because it's a lot of content. Like this jawboning here. This is the stuff that the member I just ejected was complaining about. But this is the very thing that is required for you to know how to do this mentorship the proper way. What lessons do you look at? In what order? Should I put more emphasis on certain lessons than others? Yes. The most important are the 8 lessons at the top, because you need to understand the language. The things I'm talking about in those lessons are primer. They're foundational. You need to know what these things are on a basic level, because if I'm talking to you in commentaries like this, you're not going to be oblivious to, oh yeah, he's talking about a buy side imbalance, sell side fish. Oh yeah, he's talking about an order block, or he's talking about a fair value gap, or he's talking about a mitigation block. You have been introduced to it. Okay. Some of you will get to a point because you've been marginally profitable, or maybe you are profitable before you joined in this last group here. And you're going to get to a lesson that really brings your trading to life. And you're going to feel like, man, I don't need to do anything else. That might be true, but there's things that I haven't taught yet that might be more inspirational to you and much more useful to your trading, even though it may supercharge what your results are now when you get to a certain month. Like if you get to month 4, and I talk about, if I'm not mistaken, I think it's order blocks, and I break them down, and I talk about very specific elements of order blocks that haven't been completely exhausted either. But that will make something click for you. Or it may be the things I talk about in month 5 that bring things to light. Like, oh wow, yeah, I look back a certain range of days, and what days are useful for what style of trading. I teach you the foundational principles of that in month 5. And for some of you that are intraday scalpers and day traders, that month's going to bring a lot of that stuff to life. Like it's going to really make your charts really start speaking to you. And for others, it may cause chaos and confusion that gets sorted later on. But all of you are going to have your own little periods of epiphanies, like, oh, I got something out of that. This is amazing. And then other ones are going to bring up questions that's going to feel like it's paralyzed you. Like I've seen members go up and down in this, where they come and they send me emails. That's why I say don't send me emails. Okay. Because it's very discouraging for you to feel in 1 month, feel like, man, this is amazing. Oh no, what's going on? I thought I had it. I thought I was figuring it out. And now I have more questions than I have answers, because you have shown your hand to me. You feel like you're failing, and or on the extreme, you feel like I'm failing you, when it's just the normal process of learning anything. Nobody learns something and it's always a high. It's always going to be, you go up a little bit, you hit a plateau, you feel like you're not really growing anymore, you feel like you're going backwards, and then you go up a little bit more, you hit another plateau. That's a normal development curve. Like that's normal. the first month when you come in here and you never considered looking at the charts the way I talk about it, it feels like the blinders have come off. And that feels good for the first couple months. But then we start getting into the meat of the lessons. And then it's going to require you to roll your sleeves up and say, okay, I've enjoyed the sugar, so now I got to eat the meat. Okay, I got to do what I got to do to get through this and like doing it, enjoy doing it. Because if you don't, like this lecture here, it's really, really long. If you don't like this type of stuff, you're not going to make it as a charter member, because it's a lot of theory built on the things that you're learning in these first couple months. And then we build on it and we build on it. And it's just not going to be for everyone. And there's no shame in that. If you can't continue, there's no shame. It's not meant for everyone. It doesn't mean that I haven't given you all the tools, because everybody has the same tools. At each month, they have the same lessons. But I want you to watch and see what happens. If you stick to the process and you stick to the things I'm telling you to do, like these, every single day, I'm building these for you in comparison. Your charts may not identify like mine do. They won't look exactly like mine. They might have some things on here, and you might have more things on there, okay? But you're learning what I'm pulling out of price that is important. And the things that are not of real significance, I'm not referring to. Over time, your eye will start doing the same thing. You'll look at the most important things, and the least of which are of no concern to you. It doesn't mean that you won't learn later on how to use those less significant factors for trade entries, or adding to a trade, or using it to get into a trade that you initially missed the better case entry. They're all useful, but they have a place and a time that is most appropriate at those times. Not every tool, every situation. That's what it feels like when someone comes to me for the first time and they see all my weapons. Okay, when they come into my arsenal and they look and they say, man, this is a lot of stuff. What do I do with all this stuff? Right. That's what mentorship is. Teaching you what tools to use, where and when. Nobody needs to bring everything to the table every time they sit down in front of a chart. If you've done your homework and you've done all of your analysis on a higher time frame, those analysis parameters that you've placed on that market that you have under study, they don't fluctuate day by day. We've been talking about dollar going lower. It's gone lower. Has it been every single day down? No. But when you had that 2 days pumped up and I told you don't worry about that, this is just a retracement. Some of you emailed me saying, but the seasonal tendency, and but the this and the but the that. You are going to be the ones that struggle here. If you don't trust me, you're doing everything twice, and you're doing it with fear and uncertainty. Whereas you're not supposed to have any emotion. You're supposed to watch this stuff just like I'm teaching you to look at it. You don't care what the outcome is. And then after it happens, then you go back and you look at the data. What does the data show? That these turning points are occurring at specific times of the day within an underlying premise that I've already pointed to ahead of time. And you're also seeing these same little quirky things, fair value gaps, optimal trade entry, bullish order blocks, runs on stops. There's a theme that's reoccurring every single day. Every day. Now, I'm not teaching you or training you to think that you're going to be an everyday trader. But when we get into month 2, I'm literally going to tell you how to go back through your first month's data and how to pick out how those trades were the better ones. And that's going to sound like, oh, of course, anybody can do that, ICT. No, I'm going to teach you the signatures that work towards that being the very things. And the people that have gone through the later lessons, they're going to be nodding their head like, yeah, that's exactly what it is. They're going to see later on, the first group I'm referring to here, you'll see later on that the things I spread out over lessons, I'm going to just jam you with in month 2. When we're doing our teachings like this, I'm going to literally take you in there and say, this is why this day, this kill zone was the optimal trade that you'd be waiting for. This is why with the calendar. This is why there isn't nothing on this calendar, and this is why it still would have been the day to choose to trade. I'm going to teach that. I've not taught that in any one particular month. It's been spread out, sprinkled here, sprinkled there. That's mentorship. So if you haven't fallen in love with doing this every day, you need to really, really, really start to do it. Start to really enjoy doing it. It should be a meditation you enjoy doing every day. And don't be discouraged if you don't see what I'm showing. That's not the point. That's not the point of this. The point is for you to see what I'm showing and you study it. Don't just look at it casual and say, oh yeah, this, whatever. Think about what I've talked about in previous videos. You hear me talking. I say, I believe that the dollar index has only had like this little pump up. Could it go to its bearish order block and then go lower? Yeah. But it went to its fair value gap. Just like it went to its fair value gap today on the daily chart. Went right up into a fair value gap, traded to it, and then sold off. If you don't know what I'm talking about, I'll cover it in the midweek review. Don't be concerned about it right now. But the dollar went below those relative equal lows. It went to the sell side liquidity pool I told you it was going to reach for. That is me guiding you without putting the trades in your hands.